$5,560. That is what 1 ounce of physical gold cost in China last night while you were sleeping, while the news was still loading, while most investors were waiting for confirmation that never comes until it is already too late. $5,560 per ounce in the world's largest gold market, sitting $282 above what Western paper markets were quoting at the same moment. Silver trading at $95 on Hyperlink. PAXG, the crypto token physically backed by gold, spiking to $5,600 per ounce within $50 of its all-time high. These are not random numbers thrown into a headline. These numbers are a message, and the message has been delivered exactly twice before in recorded monetary history. And both times the empire holding the reserve currency did not survive the decade. This is the third time. This is a mathematical certainty. This is not opinion. This is pattern recognition. And once you see this pattern clearly, once you understand the sequence from the inside out, you cannot unsee it. The geometry is too clean, the intervals are too precise, the outcomes are too identical. 3 empires, 3 collapses. 3 moments where the physical gold market began screaming what the paper market refused to admit. And every single time, the people who listened to the paper price lost generational wealth. The people who listened to the physical premium survived. Let us go back to Rome first, because Rome is where the template was written. At the height of the Roman Empire, the denarius was a silver coin of genuine weight and purity, roughly 93% silver content during the Republican era. It was trusted across the known world because it was real. It had mass. It had metal. It could not be manufactured out of thin air. But the wars came, as wars always do, and wars are expensive. The empire needed to pay legions, stretched across Britain, Syria, Egypt, and Germania simultaneously. So the emperors did what every desperate government does when the math stops working. They started shaving the coins. They started diluting the silver content. Under Nero, it fell to 90%. Under Marcus Aurelius, it fell below 80%. By the time of Gallienus in the 3rd century, the silver content of a Roman denarius had collapsed to around 2%. 2%. The coin still said it was a denarius. It still carried the emperor's face, but the metal inside it was a lie. The merchants knew it, the Eastern traders knew it, the soldiers eventually knew it. Within 2 generations of the final debasement, the Western Roman Empire ceased to function as a coherent political entity. The bread prices that Roman citizens paid in the 3rd century were 1,400% higher than what their grandparents paid. Verified. Now go forward about 12 centuries to the Dutch Republic, the 17th century's most sophisticated financial superpower, the nation that invented the modern stock market, the first country to issue government bonds, the empire whose guilder was the world's reserve currency entrusted from Amsterdam to Batavia. The Dutch were brilliant. They built financial instruments so advanced that historians still study them. But they made one catastrophic error. They financed their wars on leverage. The Anglo-Dutch Wars, the wars against Louis XIV of France, drained the Republic not through defeat in battle, but through the cost of sustained conflict. The Dutch East India Company, the VOC, the most valuable corporation in human history at its peak, began quietly moving physical gold out of Dutch vaults and into Asian markets where the premium on real metal was higher. The financial engineers in Amsterdam kept printing paper promises. The smart merchants kept converting those promises into physical assets in Asia. The guilder lost reserve status within 50 years of the VOC beginning that quiet physical gold migration. The empire did not collapse in a single dramatic moment. It dissolved slowly, then suddenly, exactly the way Hemingway described bankruptcy. Gradually, then all at once. Check. Now go to Britain. The British pound was the world's dominant reserve currency for over 200 years. It was backed by the largest navy, the largest empire, and the deepest gold reserves ever accumulated by a single nation-state. But the First World War nearly destroyed the British treasury. The government made promises to its creditors it could not keep in gold. So it suspended convertibility. Then came the Second World War, and a debt load that consumed over 250% of British GDP. By 1956, during the Suez Crisis, the United States threatened to sell its sterling reserves if Britain did not withdraw from Egypt, and Britain had no choice but to comply. That was the moment. That was the day the world's financial community understood that sterling was no longer backed by real power. The physical gold premium that had been quietly building in Hong Kong and Singapore since the early 1950s exploded after Suez. The pound lost reserve status within 15 years. The British working class lost 30% of their real purchasing power inside a single decade. The empire that once covered a quarter of the Earth's surface ceased to exist as a meaningful geopolitical force by the time the Beatles were recording Abbey Road. Verified. Same pattern, same sequence, same outcome. Now here is where we are today. Right now. Not in a history textbook, not in a documentary you watch half asleep on Sunday afternoon. Right now. The United States has just declared major combat operations against Iran. U.S. and Israeli forces launched strikes targeting central Tehran near the offices of Iran's president, near the compound of the supreme leader. Trump stated explicitly that American casualties are expected, that these are the words of a commander-in-chief acknowledging this is sustained warfare, not a surgical strike with a clean exit. Iran responded with ballistic missiles aimed at U.S. bases in Bahrain, Qatar, Abu Dhabi, Kuwait, and Saudi Arabia. 5 sovereign nations simultaneously targeted in a single retaliatory barrage. The UAE, Qatar, and Kuwait shut their airspace. Several major oil companies suspended shipments through the Strait of Hormuz. Iran's foreign minister had to publicly confirm the supreme leader and president were still alive, which tells you the world was not entirely certain they were. Israel stated their operational objective openly, ending the Ayatollah's regime entirely. Iran's statement in response was this: "There are no red lines anymore. Everything is possible." Yemen's Houthis announced the resumption of Red Sea attacks. We are not watching a crisis. We are watching the opening chapter of a regional war with explicit regime change objectives on both sides. And against this backdrop, here is the financial data running in real time. PAXG hit $5,600 per ounce overnight. China's spot gold dark market quoted 1,226 yuan per gram, which converts to $5,560 per ounce. Western spot at 5,278. That is a $282 premium on physical gold in Asia over paper gold in the West. Silver on hyperlink trading at $95.14. Shanghai spot silver at 105. Shanghai futures at 108. Western spot at 93. A $12 premium on physical silver between East and West that was already building before a single missile was launched. Thailand's major gold dealers halted trading entirely, citing price volatility so extreme they could not manage it operationally. Bitcoin dropped to 63,000, while physical gold made new all-time highs in Asia. Digital gold sold off. Real gold surged. The market is not confused. The market is communicating with perfect clarity. And what it is saying is that the monetary architecture that has governed the post-war era is cracking at its foundation. We are not at the cliff. We have already walked off it. This is not a sudden event. This is the crystallization of a process that has been building for years in data that most people looked at without seeing. The United States is carrying $36 trillion in national debt and adds roughly $1 trillion to that total every 100 days. The Federal Reserve holds a balance sheet that was under $1 trillion before 2008 and today sits above $7 trillion. The dollar has lost over 97% of its purchasing power since the Federal Reserve was created in 1913. COMEX registered silver inventories have been draining for consecutive months. Silver lease rates spiked 6 days in a row before any of this geopolitical escalation materialized. Open interest on silver futures collapsed from 162,000 contracts to 118,000 contracts, a 27% drop, while price climbed from the 80s to $95, which means the paper structure is not supporting the price move upward. Physical demand is. The smart money is leaving the paper system. It has been leaving quietly, methodically, in a way that does not trigger alarms until the exit is already crowded. Portfolio allocation to gold globally still sits at 1 to 2% for most institutional investors. 1 to 2%, while physical trades nearly $300 over paper in the world's largest gold market. The disconnect between what the paper price says and what physical buyers in Asia are actually paying is the same disconnect Roman merchants noticed when the silver in their coins started feeling lighter. It is the same disconnect Dutch merchants noticed when the VOC started quietly moving gold east. It is the same disconnect London traders noticed when sterling stopped behaving like a currency backed by real power. Not might happen, will happen. The smart money is leaving, and it is leaving for a reason that is not complicated once you strip away the financial jargon and look at what is actually happening. When you have simultaneous military operations across 5 countries, explicit regime change objectives from both nuclear adjacent powers, Hormuz shipping disruptions threatening 15 to 20% of the world's daily oil supply, central banks across the global south buying gold at a pace not seen since the 1970s, a Chinese recycling company in Shenzhen paying $15 per ounce, overspot for 99.99 silver because delivery certainty has become more valuable than the price itself, and a physical premium in Asia that was already $12 on silver and nearly $300 on gold before the first missile was fired, you are not looking at a war premium that will compress when the headlines calm down. You are looking at structural repositioning happening in real time by the largest and most patient capital pools on Earth. You can't unsee it. Once you understand that physical premiums in Asia are the first symptom of every major monetary transition in modern history, once you accept that 3 empires collapsed in the same sequence, beginning with currency debasement, followed by military overextension, followed by physical gold migrating east while paper promises multiplied in the west. Once you see that the data running across your screen right now is not breaking news, but confirmation of a trajectory that has been locked in for years, you will understand why ordinary people are the last to know. Because ordinary people wait for permission from the mainstream to believe what the data has already told them. They waited in Rome while the coins got lighter. They waited in Amsterdam while the VOC moved gold to Asia. They waited in London while the empire's gold reserves quietly drained across the Atlantic. They are waiting right now, watching silver at 95 and gold at 5,560 in the physical market, and telling themselves it is probably just a spike. Now let me tell you what this actually looks like on the ground for a normal person, because the academic framing of empire collapse tends to sanitize the reality into something bloodless and abstract, and this is not bloodless, and it is not abstract. When the monetary system that prices your groceries, your rent, your fuel, your medical bills, and your children's future begins to reprice itself against physical reality instead of printed promises, it does not do so in a way that gives you time to prepare. It does not send you a calendar invite. In the final phase of Roman monetary collapse, Roman citizens woke up to find that the bread they bought last week for 1 denarius now cost 3. Not because there was less bread, because the denarius had lost the physical legitimacy that gave it value. In Weimar Germany in 1923, workers demanded to be paid twice daily because prices were rising faster than a morning wage could purchase what an evening meal required. In Britain's post-war austerity period, families who had saved their pounds faithfully for decades watch their savings purchase less every single year, not dramatically, but relentlessly, the way slow water erodes stone. Today, in the United States, the average working family has seen the real purchasing power of their wages decline every year since 2020, while the cost of housing, food, energy, and healthcare has accelerated in the opposite direction. The ATMs still work. The grocery store shelves are still stocked. But the gap between what the dollar says it is worth and what it actually buys in physical terms is widening at a rate that has no historical precedent in peacetime. And we are no longer in peacetime. When this repricing event becomes impossible to ignore, and it will, because mathematical certainties are not optional, the people who are holding paper promises will discover they are holding what Romans discovered their debased denarii were, legal tender that could not purchase physical reality at any price. The people who converted paper into real assets, into gold, into silver, into land, into anything with physical mass and scarcity that no printing press can replicate, those people will not be wealthy because they got lucky. They will be wealthy because they read the same pattern that has appeared 3 times in history and acted on it before the crowd received permission to believe it was real. This is not doom for the sake of doom. This is the most important financial insight of this generation, and it is freely available to anyone willing to look at history without the ideological filters that financial institutions use to protect the status quo they profit from. Same pattern, same sequence, same outcome. Rome debased, overextended, collapsed. The Dutch leveraged, migrated gold east, dissolved. Britain suspended convertibility, lost reserve status, declined. The United States has debased its currency by 97% in 110 years, is engaged in simultaneous military operations across 5 countries while carrying the largest debt load in human history, and physical gold in the world's largest market is trading nearly $300 above Western paper price at this exact moment. This is what the third cycle looks like from the inside. The people living through the Roman 3rd century did not see the collapse as history. They saw it as current events. They told themselves it would stabilize. They waited for leadership to fix it. They held the coins until the coins were worthless. This is your moment of pattern recognition. This is the inflection point where the data makes the decision obvious for anyone who is paying attention. Hard assets, physical gold and silver held in your possession, not a paper promise of gold, not a futures contract, not an ETF you cannot redeem, actual physical metal with weight and mass and 4,000 years of monetary history behind it, are the only asset class that has survived every single one of these cycles intact. Land, physical commodities, real things that exist in the material world independent of any government's ability to print, promise, or default. These are not investments in the traditional sense. These are the life rafts that every monetary transition in history has validated for the people who had the courage to board them before the crowd understood the ship was sinking. Subscribe to this channel if you want to keep watching this unfold in real time with the historical context that the mainstream financial media will never give you, because the mainstream financial media profits from your confidence in the paper system. Every video on this channel is built around one principle, that the data tells the truth before the headlines do, and the people who act on the data before the headlines always have options that the people who waited for confirmation will not. PAXG at 5600. Physical China gold at 5,560. Silver at 95. The premiums are not noise. The premiums are the signal. And the signal has been right every single time this pattern has appeared in 3,000 years of monetary history. The wealth transfer is already happening. The only question left is which side of it you intend to be on.